FHA versus conventional mortgages, what's the difference and why should you care? On this week's Tuesday's Tips. All right, so today we're going to talk about the differences between qualifying for a 3% down conventional mortgage and a 3.5% down FHA mortgage. So what the heck does that mean?
Good question. There's a good segue for this. So big difference between the two mortgages, Jeremy, is when you have a conventional mortgage, if you're putting down the 3%, your loan will have PMI, which is private mortgage insurance, but it's not a lifetime PMI. So there's a few ways you can get rid of the PMI, but the easiest way to understand it is either when you hit 80% of the value or 78% of the original value. So that's one of the benefits of going with the 3% down. The downside is that you've got these credit score restrictions of needing at least a 620 score to get that loan.
Okay.
And when you price that loan for a client that does qualify for the 3% down conventional, the cost of the PMI has a risk on it. So think like PMI is an insurance. And think if you were a driver driving a car and you had a lot of tickets, you had a lot of accidents, as that person, you're seen as a higher risk. So the cost of the PMI ends up becoming too high for the client when you compare the FHA to the conventional buyer. So FHA will typically not penalize clients on their credit score. So you can have as little as a 3.5% down payment. The drawback is that you've got lifetime PMI with FHA unless you put down 10%. If you put down 10% with FHA, it's an 11-year PMI. Most of the 3% down conventionals will have an income restriction. They have, Fannie Mae has what's called their Home Ready program, and Freddie Mac has their Home Possible. If you're a first-time home buyer and you're above income, there still is a 3% down program.
Okay.
Ideally, those programs work better for the higher credit scores compared to the FHA. So that a lot of times is why someone is going FHA. Other restrictions on conventional loans are what's known as debt to income ratio.
Okay.
So we look at, hey, what are your monthly bills? What's the new mortgage going to cost you? And do you have any skeleton bills? Like, for instance, do you pay alimony? Do you pay child support? Do you owe the IRS and have a monthly payment plan on that? So we take all your monthly bills and we divide those by your gross income. Most conventional mortgages need a 43% debt to income ratio. Whereas with FHA, it's a little more liberal in your debt to income ratio. I've seen times where we can do 56% debt to income ratio. Now, that's a type of client I'm a little nervous for, and I'm going to have a conversation with them of what other household income is here that I don't know about that is going to help you, because this is really tight. And let's really talk about that. You know, just because we have that online approval, I got to do my due diligence and make certain that I'm not setting up someone to fail. So sometimes in that situation that I'm giving you, that person might have a spouse or a significant that maybe has some credit issues and we can't put them on the loan, or they recently started a business and we can't put them on the loan. So those are reasons why FHA may be better.
Okay. I have a question for you. So on the conventional, you said it can go down as low as 620 for a credit score. In general, if you can go down to 620, would the interest rate be better on the FHA side or the conventional side at that low of a score?
FHA.
Okay.
Yeah, even the cost of the PMI.
Yep.
And a lot of times, most lending is done online. So you run it online, it either says yes or no. Most times that 620 score is not getting approved online, unconventional.
Okay. All right. So it makes sense for someone that if they are really looking to put their best foot forward, I know it seems like a no-brainer, but they need to get their credit score up as high as possible. And I always recommend they call a lender such as yourself. So when you run the credit score and they're like, oh, it's kind of low, let's take a look at it. You can break it down and be like, look, well, I see this, this, and this. Why don't you pay that down, down. Oh, did you know that there's a collection on your credit report? I didn't know that. Who's it from? Really? I paid that, or whatever it is. And then they need to try to get that up, regardless of whether or not you're going for FHA or conventional. Because correct me if I'm wrong, if you have a better credit score with FHA, does that affect your interest rate as well?
Sometimes it does. Sometimes the lower scores will have a small difference in the pricing.
Okay.
Not as dramatic as conventional loans, but there can be a difference. Yes. But now if the score comes up and if the debt to income ratio works, and that at that point, now this person that was or looked like an FHA buyer has now turned into a conventional buyer. And you can probably speak to why a conventional buyer is sometimes from a listing agent side better. Like why from a listing agent side do you look at a conventional buyer different than FHA? You got to lay out the truth.
Great question. I'm glad you segued into that, because as you saw, I've been kind of jotting notes as you've been talking, and then I jotted a note for me to finish the segue with this. As a listing agent right now, most people I think have realized that every property, or generally every property, has multiple offers on it shortly after it's been listed. So when we're going through the offers, if I'm showing an offer to my seller and they both look identical, except one is a 3% down 3% down conventional, and the other one's 3.5% down FHA, the conventional is stronger because, as you just mentioned, that generally means they have a lower debt to income ratio, they have a better credit score, and and on top of that, conventional has different appraisal guidelines than FHA. FHA can nitpick, the age of a heating system, the age of a roof, chipping paint, railings, missing railings, maybe down to a basement or so. So the things that sellers just don't feel like dealing with in this market, and they don't really have to because it's a seller's market. So I highly recommend everyone do whatever you can to get your financial house in order, so to speak, and qualify for that 3% down or 5% down, whatever you can, conventional mortgage. It makes a difference.
Yeah, good tips. And I think, like you and I have talked about this before, and I know we've put it out before, it's never too soon to get working on the pre-approval.
That's right.
Even if it's 6 or 8 months from now, you're
That's right.
way ahead of schedule. And you can also fix stuff, because whether you're on Credit Karma or Credit Wise, not all credit reports are on there. So maybe there is that skeleton bill that's showing on a different credit report, or the lender can give you the guidance on, oh, like you said, pay this down or get that off your credit, and be able to manipulate, manipulate's probably not a good word, but be able to get the score that you probably deserve.
That's right. That's right. Yep. Manipulate, affect the score. You need to, it's a score. It's scoring what it perceives as your financial liability and your financial worthiness, of paying loans back. Now, speaking of loans, how do car loans factor in this regards? So if I have a car loan, let's say for $400 a month, and now I went and said, I really want a new car, and I go out and get a car loan for $800 a month. So there's a $400 a month difference. How does that generally affect someone's DTI? Does it have a big effect? Not a little effect? Is $400 extra a month that big of a deal?
Can be. It can be. If you're sitting at a 40% debt to income ratio, that extra 400 a month could really just tank everything. Or if you're at 48%, because sometimes, as I said to you, conventional loans, generally we need to see 43% will get approved. But there are times that the online system reads that, oh, wow, these credit scores are so high, this person has such great assets, we're going to approve it. And you've got an online approval with, say, a 48 debt to income ratio. And next thing you know, somebody decides that they want to upgrade their car before they upgrade their house. And not so good.
All right, great. Thank you for answering that. I really wanted to throw that in there because I know I see a lot of people have been pent up this last year, and I see a lot of people going out, new car this, new car that, and not that they're necessarily in the housing market, but I really want people to think before they go out and buy that new car. If you think you're going to be in the housing market in the next couple of years, be mindful of your financial decisions with this new vehicle, because the difference in the higher payments could make a big difference. Even if you're keeping the same payments, it makes a difference. So if you could pay your car off and it's still working and it's working fine, and maybe you got to put a little money into it, that might be a better idea than buying that new vehicle until after you've purchased the home. All right, I hope you enjoyed this episode of Tuesday's Tips. I'm Jeremy Bailey, your Flying Realtor. Remember to keep your wings level, and I gotta fly.